we're going to take a closer look at private credit, an asset class that continues to grow despite the very changing macro conditions. So please welcome Michael Craig, Managing Director and European Head of Private Credit at Invesco. Please make some noise for Michael.
Thank you very much, and that's a very nice welcome. So I thought I'd just start the agenda with literally quick 2 minutes on a bit about Invesco, and then I wanted to bring up two areas that I think are interesting potentially to invest in. So maybe spend 30 minutes on those. Yeah, so Invesco is a 50 billion private credit platform, and it spans pretty much the entire part of private credit, all the way from liquid CLO notes all the way down to capital solutions. And the only real difference across the spectrum is sort of the risk and return or liquidity profile. The sort of commonality, as you would expect, is we're all dealing with senior secured paper, and it's floating rate. Invesco, we operate only in the private side, hence the word private credit. And the advantage there is that, of the 700 different borrowers we lend to and another 1,000 under NDA, when we look at a particular borrower to sort of analyze if we want to lend to that company, we'll know sort of one of its customers, a competitor or a supplier on a private side basis, so we can call the management team up or the owner, which is typically a private equity company, and get a well-informed decision on if we should invest in that company or not. And we think that gives us a big edge, and particularly in periods of volatility. And I think we all know those periods are coming more frequently than they have historically. So today, I wanted to kind of talk about some of the address some of the questions that we receive a lot. I was just at Super Return a few weeks ago, and I was having lots of meetings with investors like yourself, and there's some common themes. Firstly, on the macro side, and I'm not going to go into too much detail, but clearly we've got a lot of geopolitical uncertainty, which is leading to limited merger and acquisitions. And then probably a shift away, or firms being over-indexed to dollars, moving into Europe. And then within Europe, a couple of things going on, but the most important change I think there's been is an increase in fiscal policy, and then obviously looser monetary policy. And so those sort of factors we're thinking about when we match up to what investors have been telling us what they need. So in that vein, I think, again, some of the big things that we're hearing is, one, private equity investments being disappointing, mainly due to lack of cash flows, so lack of exits, so very little cash yield. So people are looking to move away from that. Secondly, and again, bringing back the uncertainty and lack of M&A activity, deployment has been relatively modest. Investors are sort of, as I mentioned before, over-indexed to dollars, want to move more into Europe. And actually, someone mentioned the next one to me just before when I was outside, is fees. Fees have become quite important in private credit, where people, there's a lot of talk about the gross return, but realistically, when you back out management fees, performance fees, what is a net experience to the investor? And in some cases, those fees can be more hurtful to your sort of return than sort of default risk. And then two more, I think, issues that have been kind of coming up quite regularly is, and it's in the paper a lot, when we think about private credit, we think about the illiquidity premium. Like, what are you getting for locking up your money? And like trying to work out, is it a true illiquidity premium, or are you just taking more risk and that's why you're getting more return? And then lastly, there's been a lot of talk about democratization of credit and thinking about, in general, fund structures, so moving away from locked up structures to more evergreen liquid type structures. So at Invesco, we're trying to find solutions and matching that macro with those issues that are being raised. And I think fortunately the market is moving towards us that we can offer solutions that address those issues. So the first one is the upper middle market in Europe. And what I mean by that is that companies with, let's say, EBITDA above 50 million and debt stacks sort of 350 million above, so large borrowers. You know, so funds like Invesco have been lending to those companies for 30 plus years, and the market's grown quite significantly. In Europe, it's over 400 billion. But what we've seen over the last sort of 3 years, 2 to 3 years, is that the direct lenders that used to operate in the sort of core middle market, so which we would define as 20 to 50 million EBITDAs, they're starting to move up, and there's a competition now for sponsors, sponsors finding capital for their borrowers between sort of the traditional direct lenders and the traditional broadly syndicated loan players. So what does that mean? What the good thing for borrowers that they are now, so sponsors are actively choosing between, I've bought a company, should I go down the direct lending route for a large company, or should I go down the broadly syndicated route? And they're indifferent. They'll be looking at the risk return profile. Do they want certain execution? Do they want to push a little bit on the margin? Is the broadly syndicated loan market? Is it not? And they're literally switching between these markets. So it's the same borrowers are switching between their sources of capital. Why we think it's particularly interesting as an investment proposition is that larger companies typically are better shielded in periods of macro volatility. Like I mentioned at the beginning, they're better able to pass through inflation than smaller companies, better supplier terms, so better able to weather downturns. So coming back to thinking about, your risks you're taking when you invest in private credit, there's been a lot of talk about, the middle market getting excess return. We would pose the question, yes, there is a liquidity premium, but is it also a question you've taken incremental risk for those borrowers? And we think the case is yes. So what Invesco's launching, which we think is sort of the future, is a fund that is agnostic between sort of investing in broadly syndicated loans and upper middle market direct lending. And because Invesco is coming from the angle of we're a traditional player who comes through banks to source deals, these large companies don't require any meaningful sourcing. So traditionally, as many of you invest in the middle market, the story is really about sourcing, having people around Europe, knocking on doors, finding opportunities. In the upper middle market, that's not the case. It's the large sponsors that Cinven, KKR, these big sponsors, these deals well flagged, there's no sourcing element. Because of that, and actually even more recently, which is pretty exciting, in Europe, the banks that have traditionally only done broadly syndicated loans are now doing co-lending on the direct lending side. So the banks are actually using their networks to source deals for us. All that to say is that we're coming from a very low cost base. We don't have to pay the source around Europe. So we can offer investors the opportunity to invest in these higher quality companies with really good liquidity premiums. So think sort of 475 to 525 over at a very low fee. So no performance fee, very low management fee. So when you think about your net return, it's actually more or less the same, or maybe even slightly better than you would get in the middle market, where again you're taking more risk and you're giving more of that return away in fees. The other good thing I mentioned at the beginning is deployment issues where you're in a world of low M&A activity. Because this fund can deploy in both the broadly syndicated loan market and direct lending market, it can deploy everything day one on the inflows. It can provide quarterly liquidity. It can be evergreen. We can take our time on deployment into the direct lending market and make sure we're really achieving that sort of liquidity premium rather than taking additional risk. So we're really excited about that fund. We think that is really future-proof. And again, why I really like it more now than I did like 2 years ago is that we're seeing more and more of the big players in the market, like the big banks, putting sort of resources behind networking through the banks and providing origination to funds like Invesco. So switching gears to something, so that previous fund with a little bit of leverage returns around 9%, sort of monthly distributions. CLO equity is solving a different problem for investors, particularly those who are moving away from private equity, where they've been burnt on like a J-curve story or lack of cash flows. This story is really about, the story is really about cash-on-cash returns. And again, before I go into the detail, just to give you the headline numbers, CLO equity in our funds are returning 20%. It takes 3 years to deploy the capital, another 3 years payback. So even though it's equity, unlike private equity, you're getting that money back really quickly, so you effectively are de-risking extremely quickly. Unlike direct lending, for example, which is rate sensitive, because CLOs are an arbitrage vehicle with floating in and floating out, as rates go down, your equity return stays stable. So it's a great sort of great placeholder in a private credit fund to diversify your interest rate risk. But just digging down very quickly, I know CLO sounds complex, but it's actually really simple. At the heart of it, the CLO lends to broadly syndicated loans. So basically you lend to 100 to 150 different borrowers. They're all upper middle market. Most of them will be names you've heard across through Europe. It's typically around 400 million in size. But to fund those loans to those corporates, you issue bonds, and those bonds are rated between AAA and all the way down in some cases to single B. So the weighted average cost of that debt is around 200 basis points. You're receiving, let's say, 400 basis points on your pool of assets. You leverage it, 12 and a half times, and you get to a 15 to 20% equity return after fees. And the job of the manager is to actively manage that pool of borrowers through a life cycle to ensure that you meet all the different constraints within the fund. But we think it's a very interesting opportunity for investors at the moment, particularly because, again, cash-on-cash returns and you de-risk relatively quickly. The reason, CLO is also really interesting, which I'm going to go into a little bit of weeds, but it's really important, is that it's not just an asset class for good markets. It can be an asset class for more challenging markets, which is dissimilar to what you see elsewhere. So if you look at the cohort of Invesco funds, I think, we've got the most important thing you can take away from this slide is the fact that, from 2018 to 2024, we've issued multiple CLOs per year, but you can see that annualized distributions are fairly consistent. So if a market is strong, you can price liabilities tight and make the income, the arbitrage work for you. In periods of dislocation, you can buy cheap portfolios. Yes, the liabilities will be a bit more expensive, but you can refi and reset those portfolios and benefit from the pooled power of that portfolio. So whatever your view on where the macro goes from here, whether you're like a bear or a bull, there can be a place for CLOs in your portfolio because the managers are experts at driving value in different kinds of market. So someone's saying time, so sorry if I went over, but thank you very much for taking the time.